Hi, this is Randy Finney with the right side of the chart, and today is Monday, June 12th, 2017. I wanted to take a look at the charts real quick, do an update, and tell you what I'm watching, what I'm looking for today. I'll start out here with the Qs. Not much to update since Friday, although I should take that back. We're down today. I actually started this video right after the market opened. I wanted to see how things open today. I was right at the end of the video and I realized there was the snafu. A couple of the charts that I was hitting weren't loading, would show me the symbol would change, but it was the same chart. It took me about 3 charts to realize that. I was going over a few sectors. So anyways, I had to scrap that video, start over. So this one hopefully be a little bit shorter anyways. Here's the Qs. As I mentioned, we had that 60-minute rising wedge, divergent high, breakdown back test, impulsive sell-off. You can see the volume. I have the volume bars muted, but if you take a look on your chart, big volume that confirms a breakout. I'm sorry, the breakdown. And very importantly, today so far, we're following through to the downside. You guys may remember, there was it definitely charged up the bears. People like myself that were looking for a pullback. Back on, what was that, May 17th, we had a big red candle, but absolutely no follow through. Turned out to be a whipsaw signal. As I mentioned on Friday, what made yesterday a little different? Well, first of all, it was a big bearish engulfing candle. This one we gapped down. This candle engulfed, what was that? I mean, look at that. Weeks of trading in just a single day. And I often mention that. That's the beauty of shorting. You can make money. The market tends to fall a lot faster than it rises. So in just a day or a few days or a few weeks, you can wipe out months of gains in the market. So you need to be prepared for that. But where I was going with this is, more importantly, we had breakdowns on all the market leading, what I call the FANG stocks, FAA, MG, and all those charts, they were lining up, and all those trend lines that I pointed out on 10 to 60-minute charts, they were all taken out. So there it is, and the fact we're following through today is helps to confirm that breakdown. Couple things that stand out to me, and I'll talk on this. This is what I'm watching. Financials broke out on Friday. I pointed that out. We had this multi-month trading range. Talked about it quite a bit. We've been trading sideways here. Let's use this white shading tool for months now, and we broke out on Friday. Pretty decent breakout, and we followed through so far today. We're up. We've given back a little today's gains, but we're still trading higher. Now, one of two things is going to happen, in my opinion, and I'll talk a little bit about this mean reversions. The equity markets tend to move together. I'm talking all the major indices, whether it's small caps, large cap, mid caps, even the QQQ, the Nasdaq 100, although it's very tech heavy. I jokingly refer to it as a tech fund with an Amazon kicker because it's over half the stocks are technology, and then Amazon is such a heavy weighted component. But with that being said, it's very rare to see what we've seen. The drop in the Qs the last 2 days with a rise in the financials. Now the financials is just one sector, but the S&P 500 is holding up. Here, let me clear that out. See, so what we have right now is, well, we've turned negative so far. I think we were green for a little bit today, but it's not down nearly as much, nor was it down nearly as much on Friday. And what perplexes me even more is the small caps. The small caps are certainly what we call a risk on index, like the QQQs. QQQs are tech stocks. They're more volatile. When the market goes up, they tend to go up more, and when the market falls, they tend to go down more. And that's also the case with the small cap stocks. And on Friday, we actually had a breakout of that multi-month trading range. We gave back some of the gains, but we closed right up on top of there. And today, so far, we're following through to the upside. So on face value, this is bullish. However, again, I'll talk about mean reversions. One of two things is very, very likely to happen. We're either going to see the small caps, this breakout, fail, and that's my preferred scenario, as well as the financial stocks, because the breakdown in the QQQ, by all accounts, is legit. I mean, everything that I look for, high volume, impulsive selling, multiple breaks of support, not just on the index or one or two leading stocks, but all of the leading stocks. So anything is possible if they, if the bulls can turn around and undo Friday's price action, as well as today's follow up, then that would be very, very bullish. In other words, to get back above where we closed on Thursday, to wipe out all of today's and Friday's losses would be very bullish. And if that's the case, then this breakout in IWM and the financials very well may stick. However, this is a breakout. It's still on a divergent high. We haven't confirmed those divergences. IWM needs a roll over here, fall back down within the trading range. That would, this would be your first bearish technical event. That would be a failed breakout if we came back down. And I'm not talking 0.5% or a few basis points. I'm talking well back into the range. And if we do that, you'll see the PPO roll over here, make a bearish crossover, and confirm this divergent high, the negative divergence that's in place. And because of that, my minimum target would be a move back down to the bottom of the channel, the trading range, which is at 133.45. And this is a 7-month trading range, sideways trading range. I believe it's unprecedented. I put up, the weekly Bollinger Bands, or maybe it was a monthly chart. And going back for decades, we haven't seen the Bollinger Bands pinch this tight. Bollinger Bands, by the way, for those not familiar, it's just a measure of volatility. When the Bollinger Bands pinch, it means volatility is compressed, price actions really staying in a tight range, and that's what's happened here. Now, where that's significant, such trading ranges like this often act as a coiled spring. There's a lot of energy, a lot of pent-up energy, and whichever way this one makes a definitive break, not these little, we've had a couple false breaks, both to the upside and downside. Definitive break, you'll know it, and we haven't had that yet. So let's see if this one sticks and we burn through these divergences. That would certainly be the bullish case. But if we fall back down, like I said, minimum I see us going back to the bottom of the trading range around 133.45. Although my preferred target would be this 125.66 level. I think we'll break down. I would be, I'll tell you what, I'm already surprised to see 7 months of sideways trading. To see it go on for another month or two, hey, anything's possible, but I doubt that. So that's why I favor a break out of this range sooner than later. And again, that'd be my minimum target to try to quantify it for you. If I grab the line, it's going to move. Let's go to another board, 125.66 down here, roughly about a, better than 11% drop in the small caps if we get that. All right, so to wrap that up, that's what I'm looking for. The recent breakout in the financial stocks, FLF, XLF, as well as IWM. Let's see if those stick or if they fail. And again, that will also almost certainly correlate with what QQQ does. If QQQ continues to move lower, if this breakdown sticks, then these breakouts will most likely fail. All right, let's take a look at a couple other things here. Okay, let's talk about mean reversions, underperformance, or relative performance. These are, I have up QQQ, the Nasdaq 100 tracking ETF, SPY in blue, the S&P 500, IWM, which is the Russell 2000 small cap index, and then put up the Dow DIA. Use the tracking ETFs for simplicity. If you guys might recall, at least in the trading room, I believe it was at the very least, I pointed out this big disparity or underperformance in the small caps. You can see the Dow and the S&P just chugging along. Those two will mostly mirror each other. They have a lot of overlap as far as sectors and components. Even though the Dow only has 30 stocks, they're very similar. They're both large cap indices. And then, as you guys know, the Qs have been leading index, very tech heavy, tech stocks, higher growth companies. And so you can see the underperformance by IWM. And then what happened, and I talked about, we had a mean reversion. IWM played a violent, swift game of catch-up. In fact, they even exceeded that, caught up, had a little spurt there, a little corrected, a little consolidation after that move, and then shot up again. So now we have, vast outperformance. And if I zoom in now and put these lines together where the mean reversion started, you can see that the small caps have vastly outperformed the stock market, the S&P and the Dow, And in recent, at least in the last couple weeks, week or so here, especially with that waterfall sell-off in the Qs since Friday, a big outperformance. So now, where am I going with this? If the Qs continue lower, and especially if everything I just said, the breakout in IWM fails, the financials, the breakout in the financials, who are a large component of the S&P 500, if that fails, the market's heading lower, and we'll see, in my opinion, a pretty swift game of catch up to the downside. In other words, a mean reversion. So at this point, obviously I remain bearish on the Qs for all the reasons. The technical breakdowns I followed through today, which is helping to confirm that. And I think there'll be probably more meat on the bone, at least in the next few days, next week or so, on IWM, because it got so far ahead of itself in the last couple weeks that I think it will outperform almost certainly. Again, this is under my assumption that the markets move lower over the next week or so. Almost certainly outperform to the downside the SPY and the Dow, and that only makes sense. They have defensive issue stocks, dividend paying stocks, all that good stuff, and they're large cap companies, blue chips. So we'll probably see it outperform the Dow and the SPY, and I think it'll probably outperform the Qs on the downside. So to rank it in this order, at this point in time, I'm most bearish on the small caps as far as these major indices go, and second would be QQQ. All right, so that's that. 60-minute chart of QQQ, again, already covered quite a bit on Friday. There's that impulsive selling, large volume confirming it. In fact, I think on the daily chart, I have my volume bars turned down. Here, I'll turn it up for you real quick. Volume, here we go. We can look at this. Look at that volume. Put a line right there. That's the highest volume we've had since going back to October of 2015. The selling that we had on Friday, huge volume bar confirming the breakdown. So it doesn't look good for Qs at this point. Like I said, both price support has been broken, trendline support, all the leading stocks have broken down. And, I think we're going down. These are targets along the way on the daily chart, rough targets. 136, 132.88-ish, we'll call it 132.90, then 129.50. We have a trend line in that comes in around that level, so that may come in first. Let's take a look at the 60-minute chart. You can see there's a trend line back here. Probably zoom out to a 120-minute. There it is. That trend line right there comes in. But either way, this is the sweet spot. It's a thin zone down here, so we'll call it around the 133 level is more than likely where we're headed on the Qs. Another point I wanted to mention is that it's been my experience that, although technical analysis is not an exact science, it doesn't work out perfectly, and most of the times that it doesn't, it's really my fault, whoever's fault it's using, maybe you missed something. But even if you identify a perfect textbook chart pattern, you confirm it with Fibonacci projections or extensions, the market doesn't always play out perfectly. However, where I'm going with this is technical analysis tends to work a lot better during swift sell-offs and corrections than it does during gradual uptrends, especially when the market's at new highs. For example, when the market's at new highs, as it recently was, you don't have any resistance levels overhead. There aren't any because prices have never traded there. So the best you can do is use things such as Fibonacci projections or maybe a chart measurement pattern. Like if you have let's say a bull flag, you can then project if prices break out of the bull flag, get a measured target there. However, pullbacks, technical analysis works very well because you have support levels. And we'll just use two examples here. Here's Apple. This is a trend line I've had, or a support level, 145.67 is where I had that line. And you can see it captures, there's a reaction high right there on that candle, a couple reactions there. And you can see where the sell-off on Friday, if you look at the candlestick, we went down, we hammered off that level. So we tagged it and then reversed and had a semi-decent rally into the close. We still had a big red candle in Apple, don't get me wrong. And more importantly, and again, I've been harping on this trend line, as you guys know, for weeks now. Even when we were down here, I expected another thrust up. We got that. And I said the next sell signal in Apple will come on a break of that trend line, and boy did it. That's technical analysis 101. This is not coincidence that Apple had the biggest down day in months after breaking that trend line. It was confirmed on high volume. It's a very well-defined trend line, so I can't say enough about it. And then also the fact that we hit that level. There's a line I had there before we even hit it, bounced, and then look where we opened today. We gapped down just below it, tested it, fell. We're testing it again, close to it. You can see there's a little doji type hanging man candlestick there. Let's see what happens, but obviously it'd be bullish if we can close back above there, a solid close. It's not the best defined resistance level. I'll say that right now, but it is certainly a level worth watching. And again, I just wanted to point out how so far on Friday we hit it and bounced. Today we've tested it on a couple occasions and we can't get above it. Here's Apple right here. So that's the level, give or take, a few pennies in either direction. Another example is Amazon. Amazon, I pointed this out in the trading room. We had a mini crash on Friday, mini flash crash, and that means just what it is, a mini crash, not a complete flash crash. On a 1-minute chart, you can see these are daybreak lines right here. This was the start of trading on Friday. There's the close of trading. So Amazon, like everything in the queues, was selling down, started selling off, and all of a sudden there was a drop off right here at this point in a 1-minute candlestick. So a matter of seconds, really. It dropped down to about 126.80 or so. And that was a drop of almost 4%, snapped right back up. That's what we call a mini crash. And now, okay, so it happened. It happens. It's happened, many times over the years. I've seen it in other stocks. It's not very frequent, but you get those once in a while. But look where we went to. This is a trend line. I haven't touched this trend line. I created this trend line back in October 2016. I haven't modified it. You can see they're updated on 420, and I think I just had this extension there. And that's exactly where we hit. We hammered off that trend line. So call it coincidence or not. I don't think it's coincidence. Point is the technicals work well. There was also a horizontal support level there on Amazon as well. So now, where do we go now? Okay, if this breaks, the market continues lower, you can see that level is support. And the fact that we had a reaction off that trend line on Friday, as well as this horizontal level, helps to validate that as an important or a significant technical level. So your next sell signal on Amazon, and it would be a pretty powerful one because it's this, trend line that's been in place since early February 2016. So you're talking a trend line a year and a half long, several reactions. It also forms the bottom of a large rising wedge pattern, with negative divergence. So this would be a powerful sell signal. And these are the targets, all these horizontal lines. I'd expect a reaction on each one. Hard to say where we're going now, but let me just say it very clearly. This would be my minimum expectation. That's around, I don't know, what is 850 or so. We'll go from there. All right. I was going to hit on the sectors, cover the sectors in the S&P 500 real quick, but I can do that in another video or even a static post. So the things that I'm watching today, number one, do we close red again in the Nasdaq 100, and by how much? If we have a big down day, over 1%, we're trading right now down exactly 1% as I talk. But if we have another red close, let's say 1% or more, or any red close, to be honest with you, after Friday's bearish engulfing candle, that would help to confirm that as a bearish, technical event, and minimize the chance that it's another whipsaw signal like we had back here. Remember that candle on May 17th, big bearish red candle, but there was absolutely no follow through. So it proved to be a whipsaw signal. And again, we also, wasn't just the Qs that broke down, we had all the FANG stocks, Apple, Amazon, Facebook, Microsoft, you name it, they all broke down as well, those patterns. So that's what I'm watching for, and I'm watching for XLF. Will this breakout stick? So far, so good. The financials are up another, 0.5, almost 0.5%. Resistance here at 24.71 is your next resistance, and then those previous reaction highs around 23.30, give or take. Will that stick? And of course, the small caps. Will this breakout hold or fail? So right now, I have my positions that I had, heading into the weekend. I'm going to hold tight and just see how today finishes. You know, if we start to see a meltdown this afternoon, we take out this morning's lows, maybe I'll add some short exposure. If we rally up and close this market green, it's not the end of the world, but it'll give me a little pause right now. So again, that's what I'm watching, and if I see anything significant in the markets, I'll post an update either on the front page or in the trading room. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.